What's up, guys? I'm Lee Haight with a good friend, Ben Inman, Inman Equities. We're partners on a NASCAR, and here at a multifamily property. I wanted you to speak to my audience about multifamily investment contractors. There's a lot of us living paycheck to paycheck. I feel it's my burden to help these guys break out of the middle class. I've made a lot of money this year selling an apartment, and Ben, I met through Grant Cardone. And Ben, how long have you been working in the multifamily space?
It's been 18 years overall. So the deal flow kept coming in, and I just started lining up partners and taking deals down.
See, what I like most is this man has rapidly grown. He's got, how many units are y'all?
We're at 1,900 currently with 600 more under contract.
And he did it coming from a place where he didn't have a ton of net worth. He was able to use his network, and they say your network is your net worth. What were you able to do with your multifamily portfolio over the last couple of years as far as like that goes?
So it's been interesting because it literally started with zero.
Yeah.
Right? Had 0 units. And then from then till now, we're sitting at 1,900 with another 600 units in the pipeline. So we'll be over the 2,000 mark in less than 2 years. Our net worth was like $26,000 when I started this 2 years ago. And now we're sitting at $9.5 million in net worth in 2 years.
Wow. So that is what we're looking for. Contractors, friends, entrepreneurs. If you're living paycheck to paycheck or you have transactional jobs, maybe you're like me, and in the wintertime, cash is actually sometimes a tough time. I can remember, even though we sold lots of jobs, cash didn't come in, and the bills keep coming.
Right.
So most contractors I know don't sell a reoccurring revenue product. And it's me coaching contractors. That's my purpose is to build reoccurring revenue. This property that we're on right now, is an incredible value, and really what people don't understand, they see these apartments on social media that are getting invested in, and they look at these beautiful things. The opportunity is really when you add value. So what's that usually look like? What do you look for?
Overall, we look for how much upside, not only just the rents, but also, that's driven a lot by what you do to the property based on its overall condition from where it is to where you want to take it, right? That could be interior only, or that could be interior and exterior, right? And so for this property, it's obvious that there's work to be done, right? So we're sitting on site on this particular deal. We haven't even started on any of the renovations yet. Clearly, a lot of landscaping has to be done. We're going to add some pool cabanas, new roofs, new paint, shutters, new doors, clubhouse can be redone, all the interior. So you got to do these improvements. If you want to get the rent growth that this property has, and this property right now is $400 below market.
$400 below market, right next to one of the nicest apartment, like high-rise apartment communities, right next door. It's on the water, and there's a lot of job growth. There's a insurance company that's putting 1,000 jobs in just right up the street.
Right.
So people are worried maybe about a recession coming up, and what we were talking about is how someone that's living in an A property, they don't have anywhere to go. There's no upside as far as rents go, and what happens when the economy maybe goes down.
So this property right there, as an example, right, A-class deal. You let something happen in the economy, or you let their hours get cut, or they lose a job, I can tell you what's going to happen. They're going to find their way to a B-class property, which is just the next step down. Because look, at the end of the day, you're going to be driven by your budget, right? And so those people, you let something happen, they're going to find their way here. And the people at the bottom are always trying to go up to the middle. So these types of properties are always insulated. Right now, this property I would say is a C-class deal that we're going to bring up to a B-class. We also want to step it up a level.
Yeah.
And so that's where our intention is here.
That's where
bring it up.
That's where the money is. 100 plus units. You got a great deal on the doors, but we're looking to double the value in a quick amount of time. And see, construction workers, people in the entrepreneur space, like there's a lot of money that has to be had in the reconstruction of these projects. A lot of people that I know chase storms for their money, but it's not just the roof that needs to be done. There's paint, there's inside work, and some of the people in my industry have realized the amount of capital that's going into this multifamily, and they've started to start these development firms where they're doing roofing, reconstruction, and we've been talking about it for years. This is the first property that I'm going to get all in on with you, and we've talked it out, but more importantly, we really want anybody that's a blue collar entrepreneur to know that you don't have to be stuck in a transactional life.
Right.
That not only can on some of your previous ones, we were talking about payouts and the differences between your passive income investment versus others, and how does yours differentiate?
Yeah, I get in this conversation a lot, right? With different investors that want to invest with us, and different contractors, if you will, that are brokers that have very transactional income, right? So my conversation is always with them is, what happens if something happens to you when you leave here today, and you can't work anymore for whatever reason? What's going to happen to your income? It's an awkward conversation, right? Because the only answer is, for most people, is their income stops.
So I can tell you the life insurance policy, my wife, they wrote $3.8 million on the board. They started working the math backwards, and I'm like, honey, we just need more apartments.
Well, and that's kind of where I'm going with this, because once you realize that, hey, if I sacrifice now, and you hear this from all the gurus in the market, right? It's like, you sacrifice now, live like nobody today so you can live like nobody tomorrow, right?
Right.
It's one of the top guys are saying. But the point is this, say for me, I have a family, right? If anything ever happens to me, I want to make sure that my wife and kids are 100% taken care of, right? So my whole thing is about passive income.
Right.
And so that's why I'm so heavily involved in these deals, is because if something ever happens to me, they're going to be taken care of. If we want to go spend a month or 2 months in Hawaii, we can do that because we got money coming in.
Right.
You know it? And I don't
at 8%, like 8% month after month.
Correct. So
is it preferred?
Correct. So we pay our investors an 8% preferred return, and once you factor in the internal rate of return target that we shoot for is 18 to 20%, and on most of our deals we're hitting above that number
per year, and that
per year annualized.
That's considering when you sell the property
that's
too.
The cash flow, and once you factor in the appreciation on the back end at sale, and you re-average those numbers, it comes out to the 18 to 20%, or fluctuate higher.
Well, let's just do the math on this deal. We'll be closing on it soon, hopefully. You're looking at a $400 rent increase here to add $8 million in value.
Correct.
Now, what would hold you back from this?
It's beautiful. Nothing. I'm gonna do the math for you really quick.
Okay.
Right? That's if my battery don't die.
Okay.
So for instance, we're $400 below. I'm just going to use 400 as an example. The average number is like 427.
Okay.
Right? So I'm going to use 400. And
below market value.
Below market value. So we're going to bring all the rents up $400.
And that's with the reconstruction.
That's with the rehab and everything included. And so it's 108 units, right? So I'm going to multiply $400 a month growth times 108 units. That's $43,200 a month.
Right.
And then you got to annualize that. So times 12, it's $518,400. Let's just say that we only get 90% of that. Okay. Just kind of be conservative. So $466,000 is how much additional revenue we've created within 24 months. Okay. Now you take that number and you divide it by the market cap rate. Where we are in the market now, it's typically a 5.5 cap. Some people may say 6, but I'm just going to use 5.5. Right?
Well, explain to the guys what a cap rate is exactly.
So cap rate is the return on your cash if you were coming in and paying cash for the deal, instead of leveraging up with debt.
Right.
So that's what you can expect your annual return to be. So based on that, so $466,000. 466,560. Divide that by the cap rate of 5.5%. We've increased the value of this property by $8.48 million.
And I think the first thing you need is a roof.
First thing is a roof. It's good for you.
Yeah. See, the first time I started meeting with multifamily investors is about 4 years ago. I knew that I needed to learn about passive income, how the banking system worked, cap rates, and I started attending some of these meetups, and I had this idea that I would sell Grant Cardone a roof, and in the middle of that deal you came along, and the truth is, watching you build $9 million in net worth with zero money out of your pocket has inspired me to
it's crazy, man.
It's an unbelievable, and it's literally a gold rush for anybody that's willing to sacrifice a little now so that they can live big later.
Sure.
And if you're doubling your income, on average, how long do you hold these properties? What's your strategy?
So typically it's a 5-year hold. Okay. All right. And so in this particular deal, most of our deals will go straight agency debt. So it would be like Fannie Mae or Freddie Mac. But in this particular case, we got to put some temporary debt in place, which is called a bridge loan, to get us from point A to point B, where we need to get the full, permanent financing on the deal. So let's just say that's a 2-year period. So it'd be full renovation process, and then at the takeout, it'd be, typically a 5-year hold. So on average, it's a 5-year hold, but with this deal, it may end up being 5 or 7. But it's okay because the cash flow is in place.
So after 2 years, the properties had the value value added.
100%.
And your attempt is hopefully to instill some of that original investment back to the.
So when we do the takeout loan with the perm debt,
right,
we'll be able to pay back investors almost 100% of their invested capital, and they continue to own a percentage of the deal
right,
throughout the remainder of the life of the hold.
Right.
So they continue getting more residual income,
right,
even though we've returned their capital.
So I've
very
got
interesting, very powerful.
It is incredibly powerful. I have a new course for contractors. It's called the Commercial Masterclass. In this course, I talk to them about using a tool, Reonomy, to find cell phone numbers, email addresses to commercial property owners.
Right.
And when you're looking for deals, these are some of the same tools that you use to get in touch with people.
Right.
So what I tell people is that if they want to land more commercial projects, they need to become like the person that they want to sell, and then they can think like an investor. Sure. And really all that an investor cares about, what's the number one thing?
It's a return.
That's it. And so there's not emotional about it. It's all about, it's literally all about a business, return on investment,
right,
and roofing and reconstruction. They represent an unwanted expense if you're not able to raise the rents. But if you're able to raise the rents, it's an opportunity.
Right.
And so anybody that's thinking about investing, but they're looking at some of these nicer properties, what is the words of warning that you have there?
Well, going back to this building next door, right?
Yeah.
If you were to buy this property today, if that whole building was for sale, let's just say it would be sold at a 5 cap. This is a nice construction, right?
Yeah, absolutely.
And so that particular deal, I see a lot of people in the market today offering these deals, to investors where it's a 5% or 6% preferred return. They better hope they can get the rent increases that they're promising people, right?
Right.
Because that would make me extremely nervous because I don't think that the growth is in the A-class units anymore. Now, it's market by market specific, right? So there are going to be some deals that you can find that are A-class that you can ride that wave a little bit.
Right.
But for the most part, it's a very, very tight thing. So the only difference is those people that are promising the 5 or 6% preferred return, their investors are only going to, my argument is their investors are only going to see the return on the back end when they sell in 10 years.
Yeah.
Well, for us, we can give our investors 8% preferred return.
You said there was one property getting 14%.
We have 2 deals we're closing on right now in Georgia. One's a 14, one's a 15.5% cash on cash year one, and they're not in war zones. I bought one of them off market. One was actually marketed. I just packaged them together, same seller. It's just all in the strategy because you mentioned, Reonomy and how you kind of put together your database. So there's a whole structure and strategy in that alone. And so, but on those A-class deals compared to what we offer, I can run circles around the returns all day.
What I like about it too is that, I call it roof to retirement. I'm looking at my managers, my leaders in my company, and I'm saying, hey, take these big checks that we're writing. We're writing $50,000 checks, $100,000 checks, and I'm like, don't go out there and buy a brand new jacked up truck. Protect your money, get a return on investment. For us, we get to do a little joint venture construction work, of course, at a very fair price. Ben, his background is in construction, and this guy knows a value when he sees it. And so when it comes to all the different parts, how did you get all that experience and knowing what stuff costs?
Yeah, so it's a good question because I actually started as a landscape architect, right? Because I was just eager to get in the business and learn the business. I wanted to get around anybody I could possibly let myself get around because I wanted to own a lot of property.
Be in multifamily.
I wanted to be around the space. And so I got offered a job with a developer in Miami, went to work for him. He was hiring for a project manager and a landscape architect at the time. He didn't want to hire me because he thought I was too young. I was 27, and so I made him a deal. I said, "Hire me. I'll come to work for you for 30 days with no pay, and if you like how I work, we'll move forward with the deal.
That's a business, man.
If we don't, then we'll shake hands, part ways, no harm, no foul." I worked for him for 3 years, right? And I told him, so you're hiring me to be the corporate landscape architect, but don't hire the project manager because I'm going to fill both roles. And I
nice.
did.
Nice.
3 years.
Nice.
And I still have a strong relationship with him.
Well, I like what that represents, that you're willing to commit now, figure it out later, put yourself in harm's way and make the sacrifice. And I see you traveling all over the United States, finding these deals. I think the execution and locking this down, you were talking about the way in which you were able to beat 14 other investors investors out of this property. And as a firm 2 years in the making, I have to say that's really something that's admirable. And maybe many people would think they don't have enough money to invest in one of these like deals. They don't have $100,000 or they don't have $200,000. What do you think a minimum would be for them to?
Right. So for us as sponsors, we have to set a minimum, right? So we have to say, okay, our minimum is $50,000 or $100,000, but it's our discretion if we want to take less than that.
Okay.
So and it's a deal by deal thing, right? And so somebody came to us and say, hey, I don't have 50 or I don't have 100, but I got 25.
Yeah, and I want to just see what it's like.
Because look, here's the argument. It's like, okay, let's use the 25 because my goal is to create a fan, right? That can generate a return, becomes so happy that he stays around for the rest of his life.
Yeah, and see, I have salesmen that are not like the guys that are making $1 million or $500,000, and so the ability for them to put $25,000 into a property is.
You gotta start where you can.
You know what I mean? Every single year.
You gotta start where you can.
So the main thing is, guys, if you're watching this, that Ben wants to help you out. He's going to be doing a new course in my Sky Diamonds University about how to build wealth in multifamily and how to talk to multifamily owners. We're going to add it to the commercial masterclass. But he wanted to share some of the different case studies of other properties and returns with you. And if you're interested in learning more about Inman Equities, we're partners on a NASCAR. We're doing lots of joint ventures together. And one thing I like about him is he answers all my questions. He's available all the time. And where can these guys get in touch with you?
Yeah, so good question. So I love talking to people, right? And so I can't get back with everybody, right? As you probably can't either, but I do try my best, right? And so people can always reach out to me on my email, which is binman@inmanequities.com, or they can always text me on my personal cell number in my pocket right here, 615-513-3088 anytime. If I'm available, I'll respond or I'll pick up my phone, or you can click the link down below and get more information. I just love helping people.
Yeah, we're going to give you case studies of other deals. We're going to show you some insight. He's going to put together a course in my university. I'm going to give you access to it. And, you could reach out to him to answer any questions about multifamily investment. But I call it roof to retirement. There's no reason why we can't take these big profits in roofing and put them into multifamily. And, when it comes down to it, when you're working with investors, you have to work for less money than insurance, but it's steady because you got 2,000 units.
Of course.
So I'll do the work for 10-15% cheaper.
Both, right? Yeah. It's like for a contractor, go back to a realtor because they get pops of capital and they go out and buy a new car or they go buy this or go buy a watch. It's like, why? Just put your money in real estate. It's making you more money, making you return. So your money's working for you, earning you unearned income, right? And then you have your primary job that's earning you earned income, right? And so the idea is most people, instead of buying those toys with the earned income, if they invest that money, and from that invested money, they're making the unearned income, they go buy their toys with that.
That's right.
And then you go take vacations with that, buy your homes with that. That's what you need to be focused on.
Right.
And once somebody understands that concept, it will freaking change your life.
And it's not just contractors. One of my friends is a public adjuster who fights insurance companies, and he invests with many of his big clients. One of his clients has, $2 billion in assets, and he's found that by becoming an investor, not only will he get a return on investment, but he will get in that inner circle where you have the opportunity, the first right of refusal on jobs.
Exactly. So perfect point, right? So we're talking about this deal, and you're talking about investing in this deal. So my argument is always to contractors. I'm like, if I were a contractor, whether it was a painting company or a roofing company or landscape or whatever, I'm going to say, look, I want to invest in your deal.
Absolutely.
And in doing that, I would like first right of refusal, right, on bidding on the work. Understanding, you may get 3 bids. It's common, right? But I know that my foot is in the door. Not only is my money making money, but I also have a really good chance of getting a job out of the deal, right?
Yeah, absolutely.
That, to me, it's just smart business.
It's smart business.
And there should be more people doing it. But
well, I did it. That's how I met Grant. Is I went ahead and I paid for the training, I paid for the coaching, I paid for access to his TV show, just so I could do the deal. And I wasn't invested into passive real estate.
Right.
I wasn't invested into hard assets. I was just counting on my ability to sell.
Of course.
These guys. If you're watching this and you want more information on the deals, click the link below, and we'll show you how to really make some value with these properties that you're taking from a C to a B or from a B minus to a B plus. This ability here to add rent of $400 a month, and in 24 months double the income or value of this property. Right. So that's the exciting stuff that I want to be a part of.
Crazy, man.
And building net worth alongside of you, taking the lead as a mentor, man. I'm really thankful, grateful, man. Thanks for doing the interview.
Good ride.
Yeah, and maybe give them your cell phone number again.
615-513-3088. Call me, text me. Just don't send me dirty pictures. I don't respond well to those. My wife don't either.
All right, guys. Good to hear from you. See ya.
Thanks.